Welcome to the Black Heart Red Spade podcast. This podcast features long-form conversations with accomplished guests from across the globe on topics ranging from financial markets and trading to psychology, entrepreneurship, and life in general, with your host, Adrian Alberts. Derivatives trading carries significant risk of capital losses and is not suitable for all investors. Past performance is not indicative of future results. All views aired by participants are their own and intended for informative and educational purposes only. Always consult with a registered financial or legal advisor before acting on any topics discussed. My guest today is Darren Sinden, who is also known as the veteran in Macrodesiac circles. He has multiple decades of market experience. He's someone for whom I have a lot of respect. We've had many conversations on the Discord. I've read multiple of his papers that he has written, and he's an all-around really awesome guy. And I'm very glad to have him on the show today, and I hope that you guys will enjoy it. So, very welcome, Darren. It's so good to have you here. Finally.
Thank you, Adrian. Thanks for the billing. I hope I can live up to that. But yeah, it's good to get on the show.
Oh, no, more than live up to it. I mean, the conversations we've had in the past have been so interesting, and I've always liked your perspective on things and how you look at markets. You've got a very Bayesian view on life. I see that you always update your worldview as new information comes available. But before we even get into that, I would actually like to know, how did you get into markets? I love hearing people's backstories on this.
Right. Well, I mean, it's a long time ago, but we've got to go back to the spring of 1984. I was doing my A-levels in the sixth form here in the UK, and I had to think about what I was going to do. So I got a place at what would be a university now, was then a polytechnic, to study to become a chartered company secretary. But I also thought that maybe I should just see what the world of work had to offer. We had a book in our sixth form library called Career Opportunities in Your Area. I completely discounted electronics and engineering, which were the main employers in my hometown, because I basically, well, then certainly wasn't very much of a practical person. And I thought office work or commerce was more for me. And I, by chance, two of the biggest market making firms or jobbing firms on the London Stock Exchange had pages in that book. They were Ackroyd and Smithers, which ultimately became part of Warburg and then UBS, and Wed Durlac and Morden, which were consumed by initially Barclays and then Credit Suisse. So I wrote off letters to both of those firms, both of whom thankfully wrote back and offered me an interview. Wed offered me an interview in the late summer of 1984, and Ackroyd not until the following Easter. So I went along to the interview with Wed, not really knowing what to expect, and miraculously they offered me a job, and I thought, well, I may as well take this and see if I like it, and if not, I can always go back to college. Anyway, I really didn't know what I was getting into, but I never left. Basically, I never went to college, and I stayed in the markets. My first experience was learning the ropes in the back office, and then after about 9 or 10 months, I was drafted down onto the stock exchange floor. So I was very fortunate to enjoy the last sort of 12 to 14 months of the London Stock Exchange floor before open outcry trading finished, and we all went to screen and phone based. So yeah. It's only really then when I got on the floor that it sunk in as to what I'd actually got myself involved in, and that was quite a daunting experience at times as well. So when I look back at my 18, 19-year-old self, I probably shudder to think of what I was doing then. But anyway,
I can only imagine how intense that must have been, because I knew a few guys from when I started out back in 2013, I think it was, who had also worked on what we have over here as the Johannesburg Stock Exchange floor. And they also said it was very intense. You had to shove people around, and you had to really know how to get everyone else's attention.
You did. And I mean, I can remember one day will always stick in my mind. I was asked to cover for a colleague as the junior on the brewery's pitch. Nothing particularly was going on in that market, so fine. I moved around the corner from the banks to the brewery's pitch. I didn't really know the guys that well because we traded around hexagons in those days, and to be honest, you were outward looking, not looking at the people to your left and right. But anyhow, I was just standing there. Suddenly, the bell went, and there was news released, and Guinness had bid for the largest spirits company in the UK, Distillers, and all hell broke loose. It was unexpected, and it came right out of the blue. And suddenly, from being a quiet morning, there were a crowd of people, 30 or 40 deep, around our pitch, baying for a price in Guinness, Distillers, and some of the other stocks. And it was just madness. And I'll never forget, I was standing next to the senior trader, a guy called Ken Weston, and we had jobbing books in those days with pages. Sometimes they were carbon duplicates, so you wrote the business on, and then it got torn out and processed later. He threw the jobbing book away and picked up literally an A4 brown envelope and started writing what he was doing down on that, because the book, he couldn't turn the pages fast enough, the piece of paper wasn't big enough. And I had to fight. He'd be saying, go and bid Cazenove XYZ for 10 million Guinness. I had to force my way off the pitch, run down to Cazenove's box. Of course, by the time I got anywhere near Cazenove's box, the price had changed, and we were no longer interested in that deal. But it was just madness, and it went on like that the whole day. The strange thing is that almost 10 years to the day later, Guinness were involved in again. Guinness became the target this time of a guy called Bernard Arnault, who you may know as the owner.
Oh yeah, Louis Vuitton.
Yeah. Well, Guinness were involved in another deal in the States, and he wanted to get involved in that. He was a personal friend of a guy called Simon Dezout, who was the Dezout and Bevan, the broker that Wed Durlacher Mordaunt merged with to form BZW, Barclays Investment Bank. Anyway, he put the business that he wanted to do through his friend, and again, it was madness. Millions made. I mean, I think I'm right in saying that day alone, the book trading Guinness made 15 million pounds out of the trade, and there was probably, I don't know, can't remember the exact figure, but we probably billed a similar amount in commission from Mr. Arnault. So it was a different experience in 97, because we were in an office, as I say, it's green and phone based, but those were the kind of days that stick in my mind. And obviously 87 as well, the crash. The crash, that was a baptism of fire as well, coming in to the office to find FTSE 500 points down, and as a young, how was I then? 22. I hadn't seen anything like that before. It was frightening and quite frankly unbelievable. But you had to get through it. And there were scenes there on the desk of just grabbing a salesperson and saying, hold on to that phone. When it rings, ask them a price in Pearson. Whatever they say, sell them 50,000 shares. That's how it was basically get rid of it at that point. Get rid of stuff at any cost. Nearest I think I've seen to blind panic in the markets on that day.
Yeah, I was about to ask you if you've had anything worse than 1987 since.
There were some tough days in 2007, 2008, but that really, aside from the day that Lehman went bust, that was more like a slow motion car crash than anything else. 87, at least to my mind, came more out of the blue. The crash in 2007-8, that was pretty well telegraphed when commercial paper markets started drying up, and the banks had to bring their special purpose vehicles back on board, and they couldn't fund short to lend long, etc., etc. And in fairness, Lehman didn't have to go bust. It's just that the Fed decided that that's what's going to happen. So I think 87 was the biggest shock. Plus, for me, was the first time I'd seen anything like that. I mean, I'd seen modest corrections, markets rise and fall, they're cyclical, etc. But I hadn't seen a bust quite like that before. Well, not like that at all. And to be fair, it hadn't really happened for but even older hands than me hadn't seen anything like that. They'd seen bear markets, but not
meltdowns like that. Yeah,
meltdown. That's exactly the right one, because that's what it was.
Yeah, I mean, 9/11 was also a big deal for quite a few guys who, I mean, I was still in school back then, so I knew nothing about markets and trading. But I spoke to one of the guys I used to work with many years ago, and he said that 9/11 also just came out of the blue, like literally. And, you know, all you do then is, he described it to me as such. He said, first you heard about the first plane that went into the tower, then the second tower, then you thought, uh-oh, something is about to happen here. So then it's a case of liquidating all positions, that clients literally phoning in and just saying, sell whatever you have to at any price just to get us out.
Yeah, no, there was a lot of that. And of course, that's the first one that really played out on TV. And I was working at IG Markets at that point, and we had plenty of screens in the dealing room. And although we obviously didn't see the first plane going live, we saw that replayed very quickly afterwards.
Yeah.
And unfortunately, then the second plane. But my abiding memory of that day is having a client phone me up in tears. Obviously, partly to do with what he'd seen on the TV, but mostly because he'd been short British Airways. By chance, you know, like me, he was a bit of a bear of the airline market generally, and he happened to have a short position open. And he really didn't know what to do. He'd made obviously a really decent profit, but he was obviously at the same time revolted by the idea that he'd made money out of, you know, other people's terrible misery. And you know, I remember we closed the position, and he just left the money on there. You know, I don't remember if he even ever took it away, but he, you know, as I say, he was a, you know, a hardened trader. And he was literally crying down the phone to me. That was quite a sobering experience too. Notwithstanding, of course, the horror that you were watching on the TV screens as that awful day unfolded. And I do remember finally leaving the office and walking back through the city to the train home. And there was total silence among people. And everybody had that sort of ghastly grey look on their faces, as, you know, to sort of say, can this really have happened? But unfortunately it had. And I guess, you know, that's obviously the worst example, but probably, you know, the most exciting thing about doing this job and working in this industry is that you do get to live through history.
Oh yeah.
And you experience it, you know, pretty much firsthand or a very slight remove from it. And you see, you know, the knock-on effects of you know, massive macro events. And that's what keeps it entertaining. You have to balance that. Or I've found that you have to balance that against the idea that you don't actually make anything, and, you know, you have to, you know, try and reconcile yourself to whether you're making a, you know, I don't want to say a social contribution because I never thought of it in those terms, but a worthwhile contribution. But you know, I have had a crisis of conscience from time to time, but I've, you know, decided that it's better to be on the inside and, you know, trying to educate people, trying to get across a salient point of view about these events, rather than just, you know, saying, no, I don't want to do this anymore and go away and start trying to make furniture or something, which I obviously couldn't do because I'd be the world's worst carpenter. And it would remind me of this, you know, one of my uncles who made a three-legged stool, and he could never get the, he started off being a bar stool, but he couldn't get the legs of the stool to match up, and by the end it was about 6 inches off the floor by the time he'd finally stopped sawing bits off the bottom. Anyway, I digress.
No. I'm really glad you brought up that point regarding the crisis of consciousness that some traders face, you know, and making money off other people's misery. Now, I had a bit of a crisis of consciousness myself in varying degrees at different stages of my career too. Like, for example, at the beginning of the year, I did have a bit of an issue with making money off the whole Ukraine war thing, you know, like being short or long of certain positions that would have made money off it. And it wasn't until David actually pointed out that you're not actively engaging in causing misery for these people, but the positions that you are in are gaining profit from it. Whether you are involved or not wouldn't have made a difference to the outcome in any case. So you might as well be involved and profit from it where you can. And if you feel that you really want to do something, then do something with your money that you've made from a situation afterwards. And I thought that was a very good point.
Oh, it is. It's it's exactly the sort of thing that David would say. Yeah, that's exactly the thing to think about. It'd be one thing if you you know, if you set out a load of positions, like perhaps Bin Laden supposedly did, and then he crashed planes into towers to profit from it, then you've directly caused that, and you've cynically profited from those events. But to be trading around events that are happening regardless of your involvement, that's a completely different thing. And there's no reason why you shouldn't do that. And as you say, if you make money, there's no reason why you can't give a good portion of that to charities or disaster relief type things, or to help refugees, or even go further and buy some Ukrainian refugees a house if you made enough money.
Yeah.
If that's how your conscience drives you. I think you've got to separate, what you can directly influence and what you're reacting to, and those two things are completely separate things. And even it's when people, it sort of reminds me a bit of when people get on their high horse about short sellers and the mafia of hedge funds benefiting from the decline in the price of a currency, or the value of a stock. People take a view. If the view's wrong, the price will go against them and they'll have their fingers burnt. But if the view's right and they're proven right, they'll make money. That's how markets work. They're there to try and exploit inefficiencies in pricing, to point out things that are mispriced, that are wrong. And that's how they should work. We've seen the flip side in the last couple of years, haven't we?
Yeah.
With retail traders bidding up the value of worthless crap, if I can say that.
It is.
To multi-billion pound or $1 million values.
Look at GME, look at AMC, all those stocks. Bed Bath and Beyond.
I think people are starting to see through it. Finally, you saw Ryan Cohen jump out of Bed Bath and Beyond. You've seen AMC now issuing preference shares and recently filing to list another 425 million of those to raise money to pay down debt. People are waking up to the fact that these companies aren't they're not fantastically well run. They're businesses that are in trouble, and they're exploiting the way that retail traders have puffed up the price to try and repair their balance sheets. You can't blame them for that in the case of AMC, but what you can do is question the ethics of the business in the first place, and the way that some of these things have been achieved. And no one ever wants to be tail end Charlie, but that's what a lot of retail investors are finding out, that they're so far behind the curve that they unless they've been very lucky or had some a Damascene moment on the road to Damascus, they're going to do their money and do it quite largely and end up with probably a lot less than they started with. But that, unfortunately, is a lesson that traders have to learn.
I've had to learn that. I've learned that plenty of times myself.
Losing money is the way for you to learn your lesson, and for lessons to be reinforced. So hopefully you don't do it again. Unfortunately, what tends to happen in my experience of many retail traders is they don't get a second chance because they've traded or put positions on in such a haphazard fashion that when things do move against them, they're normally instantly blown up and closed out and left with pennies on the dollar, if even that. And in the bad old days of retail trading, you could leverage retail trading anyway. You could end up with a loss that was far larger than your initial deposit. That's now been capped, but the principle's still the same. And I still see people repeating the same mistakes day after day, unfortunately.
But I think that shows us that life has a reverse asymmetry principle applied to it. So, for example, I know that I use the principle of working out ad nauseum because I like training and stuff, but you're only one bad injury away from paralyzing yourself. You're one bad injury away from tearing a muscle or a fall or whatever it might be. But you're never one good workout away from becoming stronger. You're never one good deal or trade away from making it big, but you're one bad trade away from going broke if you're not careful. And I think a lot of people forget that.
I think many of them probably don't realize that that's a factor in the first place, because the way that this business is promoted is still to some extent selling people a dream. And of course, they only focus on the upside. I know the worst successes are just chances on Instagram, but even the main line industry still, for obvious reasons, still focuses on the potential to make money and doesn't spend too much time as you say, pointing out the asymmetric relationship that exists there. But people have to do their own due diligence. They have to do their own homework, and they have to experience making a loss. I think, I've said and written many times, the worst thing that can happen to a new trader coming into the markets is to make a significant profit on their first trade. It might sound a mad thing to say, but it's true, because it gives them a false impression of what's, well, unless they're the next George Soros, or or the next Stanley Druckenmiller.
Which I'm not.
Yeah, I mean, when I ran that CFD desk at IG, some of the conversations you'd have with people about their positions and the margin calls they were facing, they would just basically, they're in denial. Everything. It was the time of the first .com bust, and people were far too long of one or two stocks, far too leveraged in those positions. I can remember somebody having 30 or 40,000 pounds of a running loss on one single stock position. It's basically their whole net worth. They should never ever have got in that situation. No, but of course they weren't. They couldn't find any more to pump up their position. That's all a running loss. Then the inevitable happens. Their whole life savings are gone. They've got nothing to show for it. It was, and so that wasn't uncommon, I'm afraid. But it can be a brutal business. And if you don't respect margin, leverage, and just the general movement in the markets, then I'm afraid you are going to come unstuck. I mean, we've seen that this week at the highest possible level, or in the last week, with pension funds and this wonderful business of LDI. Who knew that existed? I certainly didn't. And now we find that not all of our pensions, but probably 50% of the country's pensions have been are being met by the use of leveraged derivatives. Now, there's an argument to say if the pension companies hadn't done that, all these things would have remained underfunded. But talking about setting yourself up for a fall, and the obvious question is, how was that being monitored? Who was monitoring it? And why weren't they paying much close attention? And clearly it was such a big problem, why weren't the government aware of that? I mean, perhaps, leaving the politics to one side, perhaps if the government had been a bit more hands-on there, and the Bank of England and the PRA perhaps had brought that to their attention, we wouldn't have seen the mini budget that Kwasi Kwarteng proposed, and we wouldn't have seen sterling fall and gilt yields rise at such an alarming rate.
That was crazy.
I can't imagine that they would have done that. Whatever their view on boosting the economy, that they would have taken those steps had they known, or if they would have done, they could have. If they would still intent on doing it, they would have at least surely have asked the Bank of England to preempt a move by providing the extra liquidity to, or collateral to, the pension funds in question, so that a move against them, that they had a buffer there. But that's what the markets show you. It's a learning curve every day.
Oh yeah,
38 years for me now, and you're still learning stuff on a daily basis.
Yeah, that's what I find too, and I think that's what attracts me to this game, is that it's probably the most exciting and stimulating game I've ever been in. Nothing else comes close, as far as I'm concerned. But it doesn't mean that it's not without pitfalls. And I would actually argue that in order to perform very well in this sport, you almost have to have the same mentality as a professional athlete, because the barriers to entry are so incredibly low nowadays. And I actually wanted to ask you about that, before we even get into that, because let's face it, with Robinhood and all these other apps that make it so easy for people to get brokerage accounts and stuff, the barriers to entry are much lower than what they used to be, at least pre-internet, when you had to go and work for a bank or a hedge fund or wherever. But the problem with such low barriers to entry is that if you want to perform at the highest level, you have to think like a professional athlete. And how many of them actually make it at the end of the day? Very, very few, relative to the number of people who participate in each respective sport, whether it's football or basketball, baseball, or whatever. And I think trading is no different in that regard. And that's why you find so many people who fail at this.
Yeah, I agree, and it's certainly a theme that I picked up in the past. I remember writing a little ebook called "Trade Like an Olympian," and what we did in that was basically look at the way that British cycling had performed, and how Sir David Brailsford had deconstructed the whole ecosystem around British cycling, and tried to make each step better. To try and find 1 or 2% improvements in every constituent part, and then reassemble the whole to create a much more efficient machine. And so there are massive parallels between trading and professional sport, and the reality is that it's quite boring. Training is boring. Weight training, running, cycling, swimming, doing the same thing repetitively every day, all day, and then doing it again the next day. But that's how good traders are made, because you learn actions, you develop muscle memory, if you will. Things become second nature. You have a plan, a discipline, you stick to it. The idea of this sort of swashbuckling maverick that comes in, picks up the phone, buys 10 million, goes out for a coffee, comes back and sells them for his month's P&L. That's fantasy. It doesn't exist. You might get lucky occasionally, but that's luck. It's not skill. You just, perhaps you can time it slightly, or you can try and push the odds in your favor. But at the end of the day, the one thing you need to be looking at is your risk reward ratio.
Absolutely.
And how much you're going to potentially lose, and not be focused on what you're going to make. I mean, I said in the chat earlier that the kind of attitude where people are thinking about how much they're going to make rather than what they could potentially lose is the reason why a certain investment bank that we won't actually name, but is in a bit of a mess, or a theoretical mess anyway, and is being seen as a potential candidate for collapse. I'm having read some more details about the funding situation there today. I think it's probably not close to collapse, but if they hadn't been quite so greedy and bonus focused and lending to dubious businessmen and over leveraging certain Asian hedge funds and family offices, then perhaps they'd have a bit more money in the kitty today than they currently have got, and they wouldn't be thinking about a fire sale of treasured assets. I would almost liken it to having an argument with your partner about what you're going to spend the lottery. If you win the lottery, what you're going to spend the money on before you've even bought the ticket. And that's the mindset, unfortunately, that some people have when they come into trading. People ask me, how much could I make them? I say, or have said when I was broking, I could lose you everything you've got, because that's the reality. Hopefully we can make you some kind of a return, but it should be risk capital. You should recognize the fact that money could disappear. So coming back to your point about barriers to entry, yes, they've got far too low. I'm not saying that we shouldn't democratize the idea of investing. No, of course not. And there are benefits to things like fractional share ownership and the ability to make regular contributions to savings plans. But there's a world of difference between saving, say, for a college fund, or deposit on a house, or just for a rainy day, and punting on the global markets in the hopes of making a return, because those are two completely different things. Poker is a game of skill, and
yes, I agree.
Game of chance. And there's a differential there. It's not quite the same comparison, but the data shows that if you're a regular saver, regular investor in stock markets, over time you will make money. It also shows that if you're a retail trader trading the stock markets, there's a 70 to 80% chance that you will lose money, and in my experience, you'll probably lose a lot rather than just a little.
Because people also don't understand how odds actually work. And I only recently learned this when I read this book called Alpha Trader by Brent Donnelly. And I'm probably going to mess up some of the figures over here, but I seem to recall that if you look at, you use gambling as an example, and we get called gamblers as traders in any case a lot of the time. But let's say you have a fair game where you have a 50% chance of making money at the end of the night and 50% chance of losing money at the end of the night. Then obviously your chance of doubling your money is 50%, which are not great odds if you really think about it, in the great scheme of things. Those are terrible odds. It's the same as a coin flip. But if you drop those odds, like on a roulette wheel, and this is where people don't realize, is that the house always wins in the long run because of a thing known as the law of large numbers.
Yeah.
Like you get a European roulette wheel where your odds of winning are 47.8%, 47.6%, and I think in an American roulette wheel it's 48.6. But let me give you an example of how crazy these odds become. If you drop the odds of winning from 50% to 49%, then your odds of making money at the end of the night drop to 11.5%, just by that 1% drop.
Yeah.
Or 0.5% drop or whatever it is, but still that's dramatic. And it just shows you how it's skewed in their favor.
Oh, absolutely. I mean, I remember, again, going back to the late 90s, reading a training manual from Swiss Bank Corporation, and it was a book designed to introduce people into their derivatives unit. Quite a bit of that at the time was above my head, I don't mind saying, but one thing that I do remember was this idea of deterministic arbitrage, which was basically the flip side of what you're saying, that when you have a 50-50 game, if you can slant the odds 1 or 2% in your favor, and this was, they used the idea of a lottery ticket, but it could just as easily be a card game or a game of roulette. But then, of course, you'll continuously go back to play that game, even though your winnings will be modest, because they will compound ultimately. And if you can do something continuously forever and make 1 or 2%, then why wouldn't you? Of course you will. It will scale. It will scale, dramatically. Across across time. The other thing I remember as well is this idea of some of these adverts you see telling you you're going to double your money, and the idea is, if you double your money 64 times, you will have all the money in the entire world ever.
Yeah, literally you would.
It's exponential growth. You can't replicate that. That doesn't happen. If it did, none of this would exist. We wouldn't be talking, and none of our friends would would be trading the markets. We'd all probably be on the beach, or maybe panning for gold or something, because that's basically what people are doing.
Yeah.
You don't get rich typically panning for gold. As a one-man band, you can, but very few people do. It's the gold mining companies that the ones with the big, the big mining operations, the great big
the house.
Yeah, the vacuum cleaners that suck up the sand on the in the riverbed. They're the ones that are making money, not you. Yeah. So people have often got the wrong idea about the markets. But that said, if you can apply yourself, you do use discipline, you are sensible, and you look for opportunities where the odds can be slanted in your favor, and trade accordingly. And perhaps the most important thing of all, leave your ego at the door and don't worry so much about why something happens. Just be, just go with the flow, trade the trend if you like. Worry about the reasons for it afterwards, but not at the time. And I mean, even at the weekend, I got hung up again as to why we sold off so strongly into the month end in US equities. We did. I mean, there were basically no buyers. I read the Goldman Sachs summary of Friday's trade. There were sellers and there wasn't much else. And then yesterday, frustratingly, we see a poor economic number. Everything's
back to normal.
Okay, yeah, it's going to be great. The Fed's going to pivot again.
Oh boy,
we'll resurrect that zombie story, and up we go. The best part of 3%. So you would go mad if you spend too much time wondering why things happen. It's nice to perhaps have a look back occasionally, and think, oh, that's the reason. But actually, when it comes to it, it's far better to be right. When I say right, well, right, it's far better to have a positive P&L than have worked out why something has happened. Largely, knowing doesn't really make it any better. If you're positioned the right way in the market, that's what's important. Or if you're not, that you recognizing that fact and doing something about it sooner rather than later is also important. So, and that's where I think a lot of people go wrong. They think there's a grand plan, some scheme that they're not
or
part
conspiracy
of.
Or
exactly,
some nonsense.
But it's got nothing to do with that at all. Occasionally you get moments of clarity and you can see things will happen and they're great, and I enjoy those, and you make a good call and it goes right and you look good, and then you say something like I did on Friday, which was I'm I'm going to stay risk on till we go, if we close below 36.40, and then I'll have to think again. And I did. And you know, and the market makes a monkey out of you in those situations. When you've got a choice of flip-flopping or do as I did and stand back yesterday, and you know, and have a little cry as the market bounces in front of your face.
And it will happen again, and it will happen again and again and again. And that's something that I've realized. I mean, my career is not nearly as long as yours. I mean, I've only been doing this for about 9 years or so, but I still find myself in situations where I capitalize beautifully on certain opportunities. And sometimes something virtually similar can pop up again in the future, and I may not capitalize on it because I didn't see it for whatever reason. It's really weird how that happens. You can't always determine how and when you will capitalize on opportunities as they come available.
No, you can't, and that's why that sort of systematic, process-driven approach is so important. Because you need to be doing the same things every day to try and be repetitive, to try and get yourself into a disciplined way of approaching the market, so that you can recognize similar situations. That's where I find technical analysis helpful, because it is all about pattern recognition and pattern repetition. Hard to say those, or at least for me.
It's amazing that people think it's nonsense. I still don't get that concept of how technical analysis can be nonsense. It's bizarre to me.
It's not nonsense. It's the people that don't believe in it that are talking nonsense. But basically, at its simplest level, what technical analysis shows you is the psychology of the market, of the participants. The point, you know, okay, you could say it's squiggles on a piece of paper or a screen, you know, and all right, I'll take that. But those squiggles show you where supply and demand changes, and that, of course, is what trading is all about. Recognizing the switch between supply and demand, between greed and fear, and recognizing which way price is going to move on that change, and being part of that changing trend. And equally, knowing when supply and demand are balanced or in equilibrium, and markets are moving sideways or in tight ranges, and knowing that that's probably not the time to be looking to trade in that particular way. It's probably the time, for instance, to be selling options, to take in premium, if you're an experienced trader and you're happy doing that. But technical analysis is a brilliant decision support tool, and you know, I've got many friends who do it for a living, and you know, their view is that it cuts out all of the noise, and just allows them to focus on the two most important things as far as they're concerned, and to some extent me, which are price and volume. You know, those are the two determinants, and you know, as I say, you can factor in supply and demand, cause and greed and fear, whatever you will, but that's what technical analysis does for me. And of course, you know, without the idea of, you know, technical analysis highlights long-standing ideas like mean reversion, those kind of things, support and resistance levels, up and down trends. Those are all, you know, those are all things that technical analysis highlights they're undisputable. They do exist. You can't say they don't. You see them in action every day. And now I start to look at some other things now, like a bit of statistics. I'm not a statistician by any means, but I like to look at things like, you know, standard deviation of a price. I think you know, I like to look at deviations from VWAP, how far a price extends beyond that. I like to look at, away from a chart, excess volume. I think that's an important thing, and excess volume over a given time period as well. I think there are all sorts of indicators.
Day types, for example, is a brilliant one too. How many times do you see certain day types forming, like neutral days, trend days, balance days, all that kind of stuff? It's really key to know.
I think so. You don't have to spend your whole time poring over charts either, but you can use them to, you know, just to have. I think everyone should know, you know, where the support and resistance levels are in an instrument they're trading, what the near-term highs and lows are, what the period highs and lows are, week, month, year, etc., and how close relatively you are to those. Because, you know, when those levels get triggered, that changes human psychology again. And when at the end of the day, whilst humans are still the largest participants in the financial markets, humans, the psychology is what markets really are. They're a distillation of all the views of all the traders in there. And I come back to the idea of greed of fear and greed, but those are the two rawest emotions, and that's what principally drives markets. Fear of loss and being greedy for profit.
Testosterone and cortisol, if you really look at it at a hormonal level. And this is something that I picked up when I read The Hour Between Dog and Wolf by John Coates. Fascinating book that I highly recommend any trader to get into. And as he pointed out that he discovered that testosterone drives bull markets and cortisol drives bear markets. Because cortisol has a massive effect on people's risk-taking ability and their risk tolerance, whereas testosterone fuels your desire to take risk and all that. So markets are auctions. That's what I think people forget, is that a market is essentially an auction if you boil it down to it. Everything in life is almost an auction. If you go to the shop and you buy a loaf of bread, you're auctioning by checking which one is the best price that you want, a pint of milk, whatever. I mean, even when you negotiate with someone, it's an auction, if you truly think about it.
Absolutely. And that sort of drifts into the area of this that I find the most fascinating, which is behavioral science, behavioral economics. And I won't be the only person by any means to be a disciple of Daniel Kahneman and Amos Tversky, but their work on prospect theory and the way that we're not properly hardwired to make decisions around financial decisions under any kind of stress at all. That fight and flight takes over. But it's fabulous, and it's and if you do subscribe to that and you do break it down, you can see that in action every day. In things like loss aversion, and the way that people seek, fall under the spell of things like confirmation bias.
Very common one that.
It's so common, and availability bias as well. When you've got those two or three things in hand or interlinked, you've almost got no chance of making money. So the longer you're spending this game, the less it becomes about the numbers on the screens, and the more about your own ability, your own approach to the markets, and that of everybody else's. And it shouldn't be so much about psychology, but it is. And of course, that takes us back to the idea of systemization, of trying to remove emotion from an ego, from decision making, and to try and have some hard and fast ground rules that you stick to. It's particularly around money management, which is so key, and about when you trade. I mean, I have a friend who runs a company called Chasing Returns, which has most recently been bought out by StoneX, and she's a former JP Morgan risk manager, and her whole premise is that you can teach people to be a better trader by simply breaking them out of their bad habits. And so what their system does is it sucks in history of trading, 3-6 months, you back up into the system, and it runs some quite sophisticated algorithms over the trading, and it highlights the points where you do well and are making money, and the times when you don't. And it will come back to you with things like you always lose money on a Wednesday morning. If you're trading around 10 o'clock, don't do it. It's as simple as that.
I don't trade on Fridays.
Well, there you go. And then it will flag up, say, but on the other hand, on a Tuesday afternoon, particularly if you're trading the energy markets, that's a time when you often make money. And so these things can actually now be highlighted and plotted and drawn out. And I mean, they're even working on something now, which will test your emotional responses to a series of questions. And it will say, the system will say to you, based on the answers you've given us, we don't think this is a good time for you to be trading the markets.
Incredible.
So go and have a walk around the block or something. Now, that's in development, as I understand it, but it shows you the way that these things are going. It's so far removed from where markets were when I started off in 1984. But
it's become a lot more sophisticated, let's be honest.
It has.
Very sophisticated.
It has become sophisticated.
But we have not.
No, that's what I was going to say. Maybe the majority of the clientele hasn't. But you can lead a horse to water. You can only put these tools in front of people if they choose to use them, and then to act on what advice or the information that's coming out of them. That's down to them. There'll still be people who put everything on black and hope for the best.
Oh yeah.
And others that will bet the mortgage money on a penny share or more recently a cryptocurrency, and see it all end in tears. We'll never change human nature. I don't
There's
think.
actually a thing called the gambling gene. I don't know if you've read any work on that, but that was really interesting for me to discover that certain people who have very pioneering spirits have it has a very long scientific name and stuff. I can't remember what they called it, but it's in layman's terms known as the gambling gene, essentially, where you are certain people are more prone to taking more risks and taking chances and all that kind of stuff. And
I'm not sure that's necessarily always a bad thing, because of course we
No,
want
no.
we want entrepreneurs and risk takers. What I think is important though is to have an understanding of the risks, to be able to quantify them for yourself.
Yeah.
And then if you decide you're happy to take that risk, then fair enough. But so many people, you said earlier, they don't understand probabilities. And not that that's a simple thing to understand. It gets very complicated very quickly. But you should at least try and have a handle on the probabilities and the risk reward profiles of what you're doing. You said about the barriers to entry earlier being quite low. What slightly worries me in America is how easy it is for people to get into options trading. And of course, if we're just talking about buying calls and puts, well, we know our downside.
That's really weird, because they ban CFDs and yet options are so easily accessible.
Yeah,
I don't get that logic.
The reason they don't like CFDs is because they're over the counter.
Okay,
okay, OTC stuff they're not keen on for private individuals to get involved in. They're happy for people to take risks on exchange. But clearly, buying calls and puts is one thing, but once you start selling options, to writing calls, writing puts, and then engaging in more complex multi-leg trades, I'm sure that most people that are doing that, well, lots of people do know what they're doing, but this new generation of traders, I have my doubts. And again, you only have to look at the chat rooms and comments to see how people are still losing money. Some people are doing very well at it. I mean, I'm not going to say everyone's a loser, because they're not. There are some very bright young things that are doing very well in options trading. But maybe the barrier should be a bit higher. In the UK, you've got to prove that you understand the product before you can open an account to trade.
I think personally, my issue with options trading is not that I dislike options. I really am in favor of using options. It's just that there are so many things to keep track of, because it's not a delta 1 or delta -1 instrument. And delta 1 and delta -1 is fairly easy to understand. If it goes up a point, you lose money. If it goes down a point, you make money. If you're delta -1, I'm just using an example. But with options, you can be directionally correct, but you might find that because of a drop in volatility, for example, especially on call options, for instance, you might actually find that just because you're slightly out of the money, that the drop in volatility in your Vega and things, for example, might actually erode the overall value of your overall
absolutely.
Option,
And then we just never underestimate the way that time value, theta just decays. I stopped. To be honest, options where I really cut my teeth back in the early 80s, but a few years later, broking and a good friend of mine who's still in the markets today, he had gone all in basically on a bid for Cons Gold, and he had a November series. And the bid came out the day after expiry.
No,
I know. And I had, well, what can you say? But it's a lesson learned. That timing is everything. And unfortunately,
and it's even more important with options, especially if you're long volatility.
Yeah, well, and now that's the other thing. Perhaps in the States, it may have gone a bit mad with all these weekly strikes and weekly series
and daily ones now too.
Well, you've got daily, weekly expiring on a Wednesday. There's such a plethora of things, but of course, the industry will keep creating new products and try and sell them to individuals. The flip side to that is I was having a conversation with a friend of mine who works for an ETF house who have an offering in single stock or single name ETFs, and they do inverse and leveraged single name things. And he was saying to me the other day that he wishes more people would take up the inverse leveraged ETFs that they offer, because in the current climate, on the right day, they're a brilliant tool for speculation. They're obviously no use for the long-term investor because they have daily resets. But if you've got an intraday view, on a particular stock that's got one of these things on it. He's saying, you know, it's a no-brainer. You back your view, you leverage your stake, and you monitor your risk. And
are you referring to? I just want to make sure I've got the correct ones in mind here, like those 3x bull ETFs on the S&P 500. For
well,
example.
This is more, yeah. Well, it's that similar idea, but these are actually over in individual stock, like Tesla,
okay,
or or General Electric or GM. It don't have to be tech names.
That's an interesting way.
Well, they're relatively new. They found a home in London in the last sort of 2.5 years, because the SEC at the time, interestingly, didn't want to have those kind of products available to individual investors. Now, in the middle of the summer, the SEC changed its mind, and then now are available in the US. But I think there are 3 or 4 houses that issue these things in London, and they are sort of becoming quite popular. I think they do 40% of the daily volume of ETFs traded in.
That's a lot
in the UK. Yeah, but it's very asymmetric. Most people are using the plain vanilla ETFs and the long side leverage, and far fewer people are using the short and short inverse. Oh, sorry, inverse and leveraged inverse ETFs, I should say. So there's asymmetry again, and he'd like to try and change that. But as I said to him, 20 years ago, I spent a lot of time going around brokerages in the UK and Ireland and elsewhere in Europe, trying to persuade them about the merits of using CFDs to take short positions, or just to hedge long-only portfolios. That was a very difficult sell, because people, for whatever reason, they like to stick to what they know, and they are reluctant to embrace change or something that's different. And again, of course, that comes back to human psychology. That changed for CFDs, of course, and they grew to be one of the most popular instruments the markets have ever seen. And perhaps that will happen with these leveraged inverse single name ETFs, but maybe not. We'll see. But that's, again, that's what keeps it exciting. New products, new developments
all the time. Yeah,
and always something to keep you on your toes, as it were.
I think leverage is a fantastic tool, provided that it works in your favor, because it is a double-edged sword too. I mean, you mentioned earlier, for example, that a large portion of UK pensions were propped up by leveraged derivatives and stuff. And while it works beautifully. So they have the ability to make you look like a genius when you are correct, but like an absolute moron when you are wrong. And that's something to always keep in mind, that it can go wrong. There are no guarantees.
Well, absolutely. I think that my takeaway from that whole LDI thing was, one, we didn't know anything about it. So, how many more unknowns are there out there? Hopefully not too many more. But secondly, why didn't the models that they were running, take into account the possibility of that? And 5 and 6 sigma events are by nature very rare. I don't even know if the moving gilts with a 5 or a 6 sigma event. I'm guessing it was, but they're not that uncommon.
It's about 2 in a billion. A 6 sigma is about 2 in 1 billion. Yeah.
Well, it probably might have been slightly less than that, but say let's call it 5. But why you can't say that they don't happen? We've seen
long-term capital management. Exactly.
You get the Lehman Brothers, Bear Stearns before, and numerous other things that happened in 2007-8. They're all unexpected events, flash crashes. There are probably 10 or 12 events over the last decade.
100%, yeah.
That would fall into those. So you can't say that they couldn't happen. And if you bring up long-term capital management, that's why that they failed, because they had the best brains in the world, but they didn't bother to model events they thought were highly unlikely, which of course is so ironic.
And that nearly crashed markets altogether if they didn't get the bailout. Sure.
No, absolutely. It would have done. I mean, then the sums were far smaller than the money we're talking about today. But then markets were, less distributed. And well, we don't learn our lessons, is what it proved. History doesn't always repeat itself, but it does rhyme. And Mark Twain said that, and it's so true, Mark so Twain. Opposite. Yeah,
I love Mark Twain. Now that you bring up Twain, he was such a smart guy, and I don't know how many quotes are really attributable to him, as in if he really said those things or not, but it doesn't actually matter, because a few of my favorite ones include, there are lies, damned lies, and then you get statistics. That's one of my utter favorite ones. And never argue with fools, because they drag you down to their level and beat you with experience.
Yes, indeed. And my favorite other two, never let the truth stand in the way of a good story. And
Yes.
and the definition of a mine, apologies to all miners, but a hole in the ground with a liar at the top, which just makes me smile every time.
That's a good one. I think he also said a lie can go around the world before the truth even gets its pants on, or something.
Yeah, yes, absolutely. And and we saw evidence of that to some extent in the way that sterling and UK gilts performed last week. It was meant to, the media whipped markets up into a frenzy. The tail wagged the dog. It was meant to be the end of the world. In fact, it was nothing like that. And I find that slightly disappointing, really. The idea that breakfast, TV presenters are suddenly dictating the economic agenda.
Narratives sell better than facts. That's the
well,
unfortunate
they
reality.
do, unfortunately, and it's incumbent upon us as traders to and commentators to take a step back from all that noise and look through and try and determine what the facts are. And that's something I always say to people. Read widely, check your sources, and constantly test your opinion against those sources. And and particularly look at contra opinions. Don't just seek out people who ape your own view. No. In fact, they you should probably exclude those on a continuous basis, really. I think when you're looking for sources of information, you soon find which are the ones you trust and the ones you don't. And I don't mind saying that I've pretty much withdrawn from Twitter because I've decided there was just far too much noise and so little substance and opinion and valid contribution. It is there. You can seek it out.
But it's like mining for a diamond in the rough. Let's be honest.
Yeah, it is.
A lot of the time, though. And I mean, Twitter is an interesting beast, though. I mean, you can use it as a wonderful tool to market yourself and your opinions and things. But wow, there are a lot of bots and things on there. You don't even know which interactions are real and which ones are not anymore.
No,
it's becoming
no, exactly. And I also found that and not now. I haven't done it for several years. It's very easy to get involved in let's call it a discussion, though sometimes they get quite heated. And that's just a waste of it's negative energy. There's no need for that. People's opinions are so polarized often on social media that you're not going to change their view. But even if you present the facts to them, they're not
interested.
No, I mean, I just pointed out the other day to somebody that I think there's a figure about 500 billion pounds had been wiped off of the value of pension funds, and I said, well, until any of that's crystallized, it's just a running P&L. And then out of nowhere, I get a tweet saying something about the Tories, blah blah blah. You're the reason that we have food banks. And I'm thinking, well, how do you get from a statement of fact to you second guess my politics, and you now suggest that I'm got something to do with the inability of families to feed themselves. Technique. Well, it's just bizarre, isn't it? Yeah. Obviously, I didn't bother to respond to that. Yeah. But that's we're digressing again. But that's the breadth of opinion, and how many people there are with ill-considered and ill-formed views.
No, it's good that we digress to this, because this is what also makes markets. People make.
Of course, it is. Yeah. You need two views to make a market, don't you? And one of them is likely to be right, and one of them is likely to be wrong, and there'll be an exchange of cash flows around that basis. And that's how it tends to work.
I'm also 100% agree. And I wanted to mention this earlier, but I completely forgot. Is that one of the reasons why I personally think, and please tell me if you think I might be wrong on this, why short selling is deemed so negatively is because people use the phrase betting against. You're not actually betting against anything. You're actually betting on the price moving down. You're not betting against. It's like saying, I took a short position on the S&P 500, for example. Oh, you're betting against the American economy. No, I'm betting on the price moving down. I'm not betting against the economy, and that's a ridiculous way of looking at it.
There's two things there, isn't there? One, of course, you're completely correct. That you're not betting against the economy, but people don't seem to understand the difference between a primary and a secondary market. Obviously, in a secondary market, whether you buy, if you buy 10,000 shares of Ford, you're not investing in Ford. No. You're buying 10,000 second-hand shares in Ford, or the rights to them, and then later, at some point later, you'll sell them. If the only way you're investing in an economy or a company or business is if you are involved in the primary markets at IPO or in a secondary issue that they come out with to raise new funds. Other than that, you're just trading something that's got a nominal value that the market determines, and you're speculating purely on the rise and fall of the value of the instrument, or you're buying it perhaps because it pays a certain income per annum, and that income, can help match off against the, your liabilities and outgoings, and you may see your money grow on top of that. But that's what secondary market's all about. Then there's this misnomer, people just don't understand, once again, the differential between primary and secondary markets. There are a lot of nuances in finance, and
it's first order thinking. Let's be honest, that's what it boils down to. And this is something that Tim and I were talking about the other day too, regarding the whole first order and second order thinking, because he wrote that piece that Howard Marks, or rather he presented us an extract from Howard Marks's piece. And I did a bit of digging into first and second order thinking, and I'm actually of the opinion that 99.9% of people on the planet do not apply second order thinking to virtually anything in their lives, whether it's markets or psychology or whatever. It's just my first impression is the correct impression, and that's it. Nothing will change my mind, and that's stupid.
It is, and what's even more stupid too is that they'll come to that conclusion without actually having any evidence to support it. None. or the flimsiest evidence. They saw some traffic in their side street, so QED, all the roads in the local area must be busy. Extrapolating things like that, or just it comes back to this idea of how people get into bubble behavior, confirmation bias, availability bias. Because I think we'll say it here, a good friend of mine says that people are intrinsically lazy when it comes to the markets or any kind of investigation, decision making. Yeah, and they prefer, and that's probably why these sensationalist news stories do so well, because they prefer to grab at a soundbite and a simple narrative rather than actually go away and do some digging for themselves and come
How many of them would do that?
Reasoned argument. Hardly any.
Yeah. Well, I mean, as part of our job and the fact that we take our jobs quite seriously, we would go and do some digging and actually ask ourselves the simple question, does this actually make sense?
Yeah, absolutely.
Have I got the right view on this, or is this view completely sensationalist? Does this conform with my biases, or is this against my biases? That's second order thinking, and you don't need to have a long list of stuff. Just even a list of 3 or 4, a checklist of 3 or 4 is good.
I don't. There are simple tools. I mean, the most important one I would suggest is you see a piece of a soundbite, some figures, some numbers. They're often, these things are offered without any kind of context. All you need to do is just look at something in the round. Claims about the UK's debt or the value of sterling, or UK government spending. I mean, Tim made a brilliant case yesterday. Germany's got a 66% debt to GDP ratio. It's got $326 billion of off-balance sheet, billion euros, sorry, of off-balance sheet spending that doesn't turn up in those figures. And that, so of course their debt to GDP figure looks better than the UK, because ours is, as far as I'm aware, predominantly on the balance sheet. And so that's quite a complex thing. But the reality, people, I just use another example. People have a fixed view about our sacred cow in the UK, the NHS. They say it's underfunded, understaffed. We spend £190 billion a year on the NHS, and it employs 1.5 million people. It's one of the biggest employers in the world. It can't, but most people don't want to know that. They just prefer the narrative that there's not enough money in the system, and there's not enough people working in it. So I'm not going to get into a debate about the rights and wrongs of that, but form your opinions around the facts rather than being led by the nose, but with sound bites and narratives that are just being constantly pushed by the media, who at the end of the day don't care. They just want to sell adverts,
ratings.
Yeah, and get ratings. Yeah, absolutely.
And that's exactly why I very much enjoy talking to you and Tim and David and the other guys, because here I have a group of people who will openly and respectfully disagree with me when I am wrong on something, and we don't get offended by it, we don't get upset or anything like that, because we can be wrong. The whole point of civil discourse is knowing that I am potentially wrong regarding the way I'm looking at something. I'm speaking with believable people over here who can either confirm my logic or point flaws in it. That's a beautiful thing. Why is it so difficult to understand that?
I don't know. I mean, people are not good at taking criticism, constructive or otherwise. But of course, as I said earlier, you know, when you come into the trading environment, you've got to leave your ego at the door. There's no doubt about that. There's always somebody that knows more than you, that's better than you. At worst, they're luckier than you for whatever reason. And you shouldn't. You should always be willing to take on board advice from your peers. You know, it's got, obviously that advice has got to be constructed and well thought out in itself, but you should always be prepared to listen. Everyone does, you know, and you've got, hopefully most people have a mentor that they can, you know, not just about the markets, but generally in life, that they can, a sounding board that they can ask that question: do you think I'm being unreasonable here? Do you think I'm being wrong? And listen to the answer, because it's the only way that you'll ever learn. If you have a fixed and limited mindset, you're never going to grow. And so one of my old bosses is very fond on doing this or this, and you want to be here. You want to have that open mindset, not that blinkered narrow mindset. But far too many people have that narrow blinkered mindset in all walks of life, not just in the markets.
No.
And unfortunately, you know, we have to deal with that. But they're the ones that are wrong. There's no doubt about that, and they're the ones that are probably harming themselves more than others. And they're the ones typically that will, in the markets at least, that will be found out and will blow up. But there we go.
I think healthy skepticism is an important tool to have in your arsenal when it comes to deal with anything markets related. And by skepticism, I do not automatically mean negativity or pessimism. You know, you need to be skeptic of the pessimism, and you also need to be skeptical of optimism when it's just rampant in either direction.
Look, life teaches you, regardless of the markets, and it's sort of coming up 57 years old. I think I've probably got a little bit of experience. Life basically isn't black and white. It's varying shades of grey. And you know, maybe if you get, maybe I think I have anyway, become a lot more tolerant, a lot more understanding of different points of views and different circumstances in life. And there's that, you know, that great saying, you know, walk a week in somebody else's shoes before you judge them, and that's you know, that's good advice. And obviously you have to extend that courtesy to people in the markets too. But the difference here is that people are often you know, risking significant sums of money and probably possibly going to go down a path that could be life-changing for all the wrong reasons. And so it's important to point out the faults that you see, or to at least, and if I can, I prefer to sort of push it back to them and say, have you considered this, or what are you doing about X, Y, Z, in the expectation that they haven't even thought of it at all. And then maybe they'll go back to the drawing board and either see that their plan's flawed or is missing something, and then perhaps add that in. And be that much better prepared when they do come to the market and put their trade on. But again, I've said it again. You can lead people. You lead a horse to water. You can't make it drinking. So people have to do these things for themselves. But you are right. Macrodesiac is a fantastic forum. I'm really privileged to, or feel really privileged to be a member of it.
I've met lifelong,
a great bunch of people. And you start to see people grow as well. They join the chat. You know, one or two people I can think of have joined the chat over the summer months, and they have a certain attitude and approach. And you look at their comments and you see it mellowing and being refined, and becoming more discriminating in the best way. And that's you know, that's really edifying to see. And in fact, you know, you also get some other interesting opportunities. Somebody who will remain nameless asked me to, in a private chat, asked me to take a look at some questions they were being asked for a job interview. They wanted to change from move into the investment banking arm of their business, and we ran through what I thought the answers were and why that was. And it seems that was, you know, instrumental in them getting an internal move, and they messaged me the other day to say thank you very much for helping me out, and I'm moving across, which I thought was wonderful. That's mentorship and helping people's career development, which is great. It genuinely is putting something back. So that's the kind of collegiate atmosphere I think we're trying to foster on the site.
And not just, and it's not a faux collegiate environment, it's a genuine collegiate environment, because I've worked at places before where they claim beforehand to have this collegiate environment, but boy oh boy, if you ask for anything, then well, no, figure it out yourself and all that. And fine, I get that, but why claim to have a collegiate environment? Macrodesiac is quite the opposite. Someone is always only too happy to help. And
absolutely.
I love that.
Obviously you can't spend all day on the site, but I sort of check in from about 6:30 in the morning, and I have a look, probably 10ish before I turn in for the night, and there's still chats going on, and there are still people happy to contribute, which is great. And worst case, people can put something in the questions or question of the day chats, and that will get picked up the following day, and again there'll be plenty of feedback, and not just feedback, there'll be concrete examples, bank research, articles.
I love that stuff.
Tim's a whiz, isn't he? If somebody asks a question, he's got either he or I have written something about it, or he's got the piece of research to hand that proves or disproves, or or sheds light on a subject that perhaps someone's not asking the right questions about. So it's a great environment, and I think I can only imagine it's going to go from strength to strength, to be honest.
No, I think so too. I've actually got Tim on next week in a panel discussion with Aisha Tariq and a guy called Markets and Mayhem, and that's going to be a very interesting one, because I've never actually done that before, and it will be interesting to see 3 different analysts and myself having this kind of discussion that we are having right now. So
those kind of things can work well. I think obviously but that's coming back to something that Macrodesiac does. It's important that everybody gets a voice. So that's the beauty of a well-ordered chat room, or Discord as we must call it now. Just as an aside, what a fabulous tool Discord is, isn't it? I mean,
it is awesome. I love it.
I probably know 10% of the things it does, but it's it's a beautiful tool. And if an old timer like me can get their head around it, then young people are going to take it to.
But technology is so amazing if you look at what it's enabled us to do. Look at us here sitting on opposite ends of the world, and we are literally having a conversation in real time. No lag, nothing.
We are. It was available 25 years ago. I used to live with a money broker, and she had some immensely capable technology in her office. Press a button, speak to anybody anywhere on the that was on the system on the globe, and and their system also called the market with an artificial voice. It basically called out the price in dollar yen, which was incredible. So this kind of stuff has been available, but that would have cost millions. Discord, it's not completely free, but it's hardly a £1 million investment for anyone who's using it. And things on it are free. The chat, the ability to reach out to people, to talk to them, to share content, it's all encompassing. That's why I think it's so good. And I use quite a few different chat apps, starting with Skype and then through WhatsApp and now Discord. But you can see a clear evolution. And I think, to be honest, I'd say I prefer Discord to things like Slack. Which
I do too. Discord's much quicker than Slack. It doesn't have that lag that Slack has at times.
There we are. So that's what's changed. We're as traders today, we've got far more tools and methods of communication at our disposal, which is a double-edged sword, I suppose, because it means that you're never out of touch, and false stories can spread very quickly.
Always a downside.
But it also means that there are wise and older heads and cleverer heads, available that you can ask a question to and expect to get an answer back one way or the other, fairly quickly, which is incredible, because that wasn't always the case.
No, definitely not. Before I let you go, do you have any exciting new projects coming up, or things that you're working on at this stage?
I've been trialing a couple of new price displacement trading systems, but unfortunately, I haven't really been able to get them to do what I want them to. I'm quite a man of simple taste, and I want certain information. It's not necessarily information that's readily available.
Have you heard of a system called Infront by any chance?
Yeah. Now, funnily enough, I've just been trialing that. I think it's a great system.
They have new management now, so I don't know what it's like now. But
very good, very good. In fact, my most recent trial finished today. No, I like it. It's got tons of information on it. Probably, if I'm brutally honest, a bit too much. And I sort of suggested then that maybe some of the interface maybe needs to be softened or maybe compartmentalized. But in terms of value for money, I mean, it's
not bad.
Oh no, a fifth of the cost of a Bloomberg terminal. Yeah. But of course, it doesn't have all the functionality of Bloomberg. But then who needs all the functionality in a Bloomberg? Probably 1 in 100 users, 1 in 1,000 users. So on a relative cost basis, it's brilliant. And particularly if you're very much involved in the sharp end in terms of executing business, then I obviously I'm not the world's expert on that anymore because I haven't been doing that for a while. But from what I could see of how the system worked, you could do a lot worse for the £500 or £600 a month that I was quoted to have it. I think it's a no-brainer if you're at that end of the spectrum. I've got this desire to build an all singing, all dancing system, but I'm afraid my coding skills and my concentration times are letting me down. So
it's surprisingly difficult, isn't it? To build something like that.
I'm always working on that, Adrian, and I'm always on the lookout for sort of new indicators and better ways to spot opportunities as and when they occur, and to do that in as near real time as possible. So that's where my focus is at the minute. And I suppose I ought to at some stage start my own podcast, but that's on the list of things to do. But for the minute, I'll be happy to come along and join more experienced and more cultured hosts like yourself.
Thank you. I'm working on the whole cultured bit, to be quite honest, but it's been a fascinating journey for me too, doing the whole podcasting thing. I mean, 2 years ago, I never would have done this. I would have been way too afraid to do any form of public speaking. And quite honestly, the sound of my own voice freaked me out until I realized that I'm the only one in the world to whom my voice sounds any different. No one knows any better. and that was a big revelation for me. It's weird, but it really worked.
Yeah. No, I've always done it since 2000. I've done quite a lot of TV and radio, and then the obvious thing that somebody, well, it's not the obvious thing, but a good piece of advice that somebody said to me was, just imagine, this is public speaking in general, but just imagine that your audience is on the toilet. They're everybody goes to the loo, don't they? It's a great leveler. So don't worry about that. The strange thing is that when I started work at 18, I was actually scared of the telephone. I don't mind admitting that. It's a funny business but it's a strange business to have gone into. Because the phone featured, even though we were on the market floor for most of the day, the phone was a big part of after-hours trading, and you had to. You couldn't shy away from. You're expected to pick it up within a couple of rings. So there we are. But again, that's about personal development, isn't it? And growing. And if we can all do that, even in a little way, day to day, we'll all make our lives and our trading life a lot better and hopefully a lot more efficient too.
Oh yeah, definitely. This has been one heck of a fascinating conversation. I mean, I actually felt like it wasn't even an hour that passed. It felt like that.
It has gone quickly, yeah.
Because we have so much to talk about, though. I would actually love to have you on for a follow-up sometime.
Bring me back, yeah. I'm happy to do it. I'd love to get. I'd love to. I've mentioned mentoring, and I there's no point in me having all this information and knowledge stuck in my head. And not sharing it with anybody because it's completely worthless unless it's out there.
What we can do next time is I will actually bring on another guest or so, then we can have like a 2-3 way conversation or something.
Lovely.
Yeah, because I think you have so much to share, and I like hearing different people's opinions on things, and it would be wonderful to have you on a panel like that sometime if you're keen.
I'll be very happy to do it, Adrian, anytime. Just let you know, and if I can make it, I'll be there.
Absolutely. Thank you once again, and have a fantastic day. And
Thank you.
Cheers, everyone. Thanks for watching.
Thanks, Adrian. Bye-bye.
Bye-bye.
Thank you for listening to the Black Heart Red Spade podcast. For more information, please visit our website at www.blackheartredspade.com or follow us on Twitter at BHeartRSpade.